Even in an AI-focused world, MacroEdge is in the business of focusing on you. We don't just understand our clients, we listen to what's said and illuminate on what's not. In a world moving at the speed of light, with shifting markets, evolving workforces, and non-stop disruption, MacroEdge helps you to navigate and identify novel opportunities, expand your enterprise, and succeed in tomorrow's world. And it all starts with you. Put your enterprise and your perspective in the driver's seat. We're in the business of you.
Good evening, everyone, and welcome to MacroEdge Radio. Slight delay there as my phone, or actually X, was playing these squirrely games with me. Apologize for that gap to start the show off. Welcome all to our new time for MacroEdge Radio. This is John Galt speaking, and the reason we've moved it is because we all have schedules in our lives that change, and hopefully we can bring more guests on at this time. Fridays, I know, are inconvenient times for many people. We all have to deal with that. That's part of life. What we're going to do is have a series of guests on tonight. It's going to be nice to actually have a chance to talk about some of the issues that have hit, including the market, including real estate. We're not going to go into geopolitics tonight. I think we all have had enough of the Iran-Israel war for a week, a month, a year, etc. So we're going to take a break from that because it writes its own story. And if you don't understand the geopolitical and economic impact of that, you might want to sit there and just tune into America's Got Talent, or go lick the drywall in your home, or possibly even go and watch Tom Lee on CNBC at 3 o'clock on Friday afternoons, which will, can't guarantee it, but for most sane people, will drive you to heavy drinking and other substance abuse possibly. I don't recommend the other substance abuse, but whatever floats your boat. Let's do a quick market review, but before I do that, as I was just posting up on X, I hadn't had a chance to scan all of my news sources because my week has been insane. We've had 2 credit failures this week. The Aldersgate Federal Credit Union in Marion, Illinois was conserved on Wednesday. I just broke it on my website at johngaltfla.com. I know that MacroEdge will be all over that now that they know this. And then tonight, Seoul Federal Credit Union in Austell, Georgia was shut down. Yes, so the credit unions, which do have a new supervisor in Washington, D.C. that was approved recently by the Senate, is starting to get unwound. And that's probably a reflection of things more than just housing. But we'll sit there and try and tie it all together. I have not had a chance to go in depth into their books, to look at their paperwork, to see what the hell's going on there. It just flashed across my screen. Keep in mind, we haven't had bank failure Friday because, reality check, folks, we don't have a head of the FDIC right now. And God forbid we were going to have any bank failures in the first 100 days of President Trump, because President Biden wouldn't sit there and allow there to be too many bank failures. Now we may have some very weak, possibly insolvent institutions out there floating around. When they do hit, I have the funny feeling it's going to be just like it was in the old days, where I'll be reporting on 1 or 2 per evening. Another reason it is ideal to have this evening slot. If you listen to my old radio show back in the 07, 08, 09, et cetera period, I used to rattle off 10 to 15 minutes worth of bank failures, credit union failures, and mortgage company failures every evening. Hopefully we don't return to those quote unquote good old days. However, I was younger and a lot better looking, so there were some advantages to 2007 and 2008. Quick market summary for all of my listeners, and then we're going to get right to our guests. The Dow today rallied, which I figured it would, and finished positive at 35.16, up 35.16. NASDAQ down 98, S&P down 13, and it was a good rally off the bottom there. Russell down 3. You got to paint the tape. Something's got to happen. They're trying to get out. If you're a short, you're getting out before the long weekend. If you're a long, God bless you, good luck, and I hope you have lots of liquor in your liquor cabinet. Gold was hit hard today. Oil went down slightly, although WTI bounced. Brent was hit a little bit hard. We're not going to go into great details of that. Bitcoin got zapped again. People were looking to raise dollars. But The bottom line to all of this is if you wanted to be long heading into a weekend where the United States of America could be bombing a nuclear facility, or as George W. Bush would say, nuclear facility in Iran, God bless you. You got bigger ones than I do. Without further ado, and we're going to bring our first guest on. He has one of the more interesting handles that I've talked to. He goes under the handle of Pharma D in Kansas. He is a long short trader and investor. His has his own Discord, and he does have a lot to talk about. When we finish with him, we're going to go to Lance Lambert and Mr. Awsumb, Ulysses Awsumb, to discuss the real estate market, which has actually gone totally insane. Without further ado, Mr. Farm, welcome to MacroEdge Radio.
Good evening, ladies and gentlemen. How are we doing?
We're doing good here in Florida, except for it's our rainy season. So you picked a good night to come on. The storms passed early like they used to. So please fill us in a little bit about yourself, about your website, your Discord, and what have you seen in the markets lately? Because what all of us have seen is insanity, especially when you see companies like Circle skyrocketing on no profits. Go ahead, sir.
Yeah, I mean, so I do a little bit of everything. I do mostly specialize in trading ES futures right now, just because, you know, when your bandwidth is a little bit stretched, sometimes it helps to, you know, have something to focus on. And it sort of has become my second wife, I suppose. So, you know, and really you want to have a good feel for what the broader indices are doing, of course, you know, if you are dabbling in any kind of longs in any kind of sector anyway. And so I do a little bit of both, but primary service is, you know, I like to say, you know, the ES trades, the day trades are like the dividend, and then really the longer term value is, you know, I like to teach. It's not like I don't run an alert service where I'm, you know, calling out 5, 6 shitty trades a day that are going to stop you out over and over again. I like to share what I see and how I trade and how I interpret the action. And, you know, sometimes I tend to see some things very early and very different that many people don't see in the tape. And, you know, I think there's people that have learned a lot from me. And, you know, it's not for everybody because, again, you know, a lot of people are looking for just those alerts. And that's not just what I do, but I do alert my swings and I'll occasionally alert a day trade. But that, you know, that's my primary focus. I know, you know, being MacroEdge, it's kind of more of a macro pod. You know, my macro credentials, I do dabble, you know, but for, you know, disclaimer, I don't get into debates about macro, but my credentials are, you know, basically I took AP economics in high school and spent most of that time in the backseat of a Camry. So, well, just to say that I'm just about as qualified as most macro economists. So I do tend to get things right because I watch all of these instruments all the time and watch how they behave to various different news, various different areas on charts, and tend to get a clue a little bit early. And one example I'll give you guys, and I think Don and I had talked about this months ago. You know, we had a situation, this was back beginning of the year, when really there were no concerns about growth at all, right? It was, you know, is inflation coming down sufficient for the rate, the Fed to cut? I'm like, that was really all the market was thinking about. Well, we got a soft ISM print. I don't remember what month it was. And the algorithmic reaction, the immediate reaction was to sell the dollar, bid bonds, and sell the index all at the same time. That was the first time we had seen that reaction. Now, the human reaction came on, you know, within a few minutes, and we just kind of went back to normal. And I said, like, you know, hey, I think the market's gearing up to get ready for, you know, potential growth scare. So let's watch for that. And that was very early. So like that's really how I apply my macro, because you know we all have our opinions, and we can be right or wrong. But you know what the market is telling us is sort of hard to deny. So I'm watching what volatility is responding to in some of these macro instruments. So that's just kind of generally how I trade, how I macro, and what I do. But yeah, mostly focused on the index. And what I'm seeing right now is a bit of distribution, right? We saw some exits, watching things very, very closely at the beginning of this week on some of these rallies up into range highs. We came into a very important spot on ES futures, which if you don't back adjust your chart, we made a higher high. Again, if you don't back adjust your chart, but it was a high that was critical. It was a high that we put in during the December FOMC and during the January FOMC. It was a very critical spot, 6105, 6113 range. And you can see looking at your chart that it rejected pretty hard. Now, different chart, just looking at SPY and SPX, we did not make, a higher high, just sort of came up to range highs. And it does, I think, now start to look potentially a little bit distributive. Now, does that mean that we're going to crash 20%? No. NAAM hit 94 this week. So maybe it's not the best time to be initiating new longs. But it feels like it's probably time for a little bit of a pullback. And we've seen a little bit of that here. And then the question is going to be, is this going to be, finding a weekly high or low to then just rip off to the moon? Or is news going to settle in now that we've hit post-op X and suddenly things are going to matter? And so that's what I'm watching into next week. We've got effectively a 2-week balance that we've made these last 2 weeks. And breaking that to the downside brings us our pullback if there's continuation there. And then we just see, where the dip gets bought. We started the year expecting a correction. We got that correction. It turned into something more. Because in the midst of it, we had a little bit of, the tariff nonsense. And a lot of people assumed it was a bear market simply because we went down 20%. You can't really tell if something's a correction or a bear market until afterwards. Obviously, we've rallied up now, and most of the same people that were calling it a bear market are now calling it a bull market. And we're going back to, 6969. New highs at 6969. So, we'll see. There's just so much going on this year. Obviously, the geopolitics are highly relevant right now, but the data has been a bit interesting, right? We've seen some areas where things are a little bit soft, and some areas where things are a little bit, potentially coming in hot, and that's really how it's been the last couple of years. And I'm really watching to see, services and labor, how they act, and if we get any kind of deterioration in the coming months. Before impacts of a potential big disgusting bill and excessive fiscal spending come in and, maybe stick save things. So, we'll see. I think it's going to be a long, rough year. And I'm definitely not looking to be long anywhere near these range highs.
I don't blame you at this point in time. I'm more of a long-term analyst from that perspective as a historian. And I watch the logistics space and, of course, gold and silver closely. I've talked about that for ages. Looking at this 5-year period, we really have been on the proverbial talking heads road to nowhere. And at some point, there's going to be a break up or down. And I wouldn't even dream of asking anyone their prediction on that. But with the instability, not just geopolitically and economically and domestically, it does make me and a lot of other people take pause. Is it a good time to start some major hedging? Because I've seen the same distribution patterns you have, and they're not pretty. This is not mom and pop selling. This is the big boys coming in and liquidating at the tops. And mom and dad think, okay, buy the BTFD again. And are they not usually the ones who get burned the worst when we get another corrective move?
Yeah, I've seen this as, maybe not in terms of size as big of an exit as, December, January, February. That was a 3-month process. And here we are right back to that sort of same spot. But it seems about as urgent, I guess, as it felt back then to get out. And so we are finally starting to see some size. But until there's meaningful supply overhead and trapped longs, we're not going anywhere meaningful to the downside. And that's where, next week is going to be huge to see if we get a clean break of, let's say the lows of the last 2 weeks, including this week. Do we see continuation to the downside? And then, what does that downside bring? Are we talking about, 580 SPY ish, 5840s on SPX maybe? That's kind of a big spot to be watching. And then, from there, we start talking about something, maybe a little bit more serious. But I still see, most, I'll talk SPY since, probably most of the listeners are watching SPY. We could even come back down to like 568s. We put in like a 7-day balance range there. And we could still hold there and maybe just end up chopping 568s to 590s or something like that for a little while. But it just feels like we are biding time. And like you said, we've gone nowhere. I mean, certainly in inflation adjusted terms, we've really gone nowhere. And so it's been a tough spot to just sort of buy and hold. But if you can pick your spots, though, if you can pick your spots on these corrective moves, even if it's 5 to 7%, then it's going to feel a hell of a lot better than buying anywhere near these range highs for sure.
What do you make of the divergence between some of the major, and I'm not going to use the Mag 7 terminology because that's worn out and I think already starting to dry out and rot away, but the larger cap stocks versus small caps at this point in time? There are a lot of divergences appearing. And the other thing that's disturbing to me from a technical perspective, and if you have any opinion, I'd love to hear it. I'm seeing a lot more volume and activity in the penny stock sector on the NASDAQ, driving the volume on the NASDAQ versus real productive companies with earnings. That's usually a very dangerous sign, especially heading into the autumn period, which is seasonally very poor for equities.
Yeah, I think you've seen, particularly in some of the big caps and the big tech, let's take like Google, for example. I mean, clearly we saw exits there. And I made a post on X last night, like, okay, I see you hiding out in Microsoft, right? And so a lot of times, at least in my experience, you'll see it used to be Apple, right? A lot of times you'd have the money that, wasn't ready to be cash, right? That wanted the equity exposure. Maybe they'd move into Apple before a corrective move. But yeah, you're seeing these divergences within the big caps where some of them are just not performing very well, and clearly exits are being taken there. And then you've got a couple other ones that look reasonably strong still. And then you're right. I mean, and this is what happens all the time, right? And as you get sort of extended towards the highs, a lot of times you start just squeezing the absolute trash, and seeing the speculative excess on some of those smaller names. And so squeeze out those shorts. Nobody's got any hedges on board, whether they've been burned on puts already or they were hedging by shorting trash against their longs. Now they're a little bit exposed potentially once that trash gets squeezed. So it's definitely not a good look. And I'm very careful here. I definitely added some hedges, and maybe a little bit more than some hedges, and I do expect to be on the offer next week. It's been a while since I've been able to catch a meaningful short. Just these brief liquidations, and you've had to treat any kind of short as a rental in this market, because a dip does get bought. But catching those liquidations is nice if you're a day trader for sure. And again, we'll see next week if we can really start to build some volume and some value lower and lower. Then we may catch some inventory trapped a little bit off sides and see them go ahead and let go of that.
Well, our own Six here, who's part of the team, and I've had this discussion. Do you feel, as I do, that the zero DT option game gamblers, as I call them, has distorted the actual veracity of the moves up or down in some of the intraday activities?
Yeah, I mean it's definitely a very, very different market for sure. And depending on how the larger participants in zero day, are positioned for a given day, you may get, let's say, less of a downside move than you otherwise might have gotten. That certainly happens in some circumstances. And in other circumstances, you get these this wild intraday volatility, whereas like, the index may close flat for the day, but, within the day, you have, kind of these wild moves that are exacerbated by zero day. Now, from my perspective, I still feel like the index trades extremely technical intraday, at least by my methods of technical analysis, using volume profiles, supply and demand, price, market profile, some of these things. But I mean, the moves are definitely exaggerated sometimes in a reversion direction, and then perhaps muted in other cases when there's significant positioning on the downside that cushions things. So it's very interesting. It's almost like one of two things needs to happen. Either there needs to be a big enough overnight move to catch somebody significantly off sides, to get a big squeeze upward or downward, Or you just need to see that, supply start to get trapped, the 0-day positioning shift into more, downside allowance, I would say. But that's usually what happens, is that it takes a while to change that trend, particularly to the downside, right? I mean, markets are designed to go up and to the right. So your reversals to the upside tend to be a little bit quicker, and then people pile in. The downside, those reversals take a little bit longer. And it's not really until you get some of that trap supply overhead that you see participants start to position in 0-day a little bit more to the downside and open up ranges a bit.
The one question I have to ask, because it's a strange question before I get into some of the technicals. Do you find it disturbing that we're now issuing leveraged ETFs against individual equities?
I mean, like, is that really something we need? I mean, I'm kind of a boomer, I guess. Maybe I'm not that old, but I kind of am. And I just think it's stupid. I just don't understand why we need that, leverage upon leverage upon leverage everywhere. That's not something that sits well with me. And again, like, maybe that's just the boomer in me. The kids love it. I mean, I get it. Like, it's nice to have these different, trading vehicles. If you've got, like, say, Nvidia, and like you can't buy that many shares at 143, but you'd like to have some exposure and some additional beta, and there's a levered ETF that's $10 or whatever the hell it is, either in the up direction or down direction, that's nice and that's convenient. But yeah, I just don't see it as necessary at all. And it just seems like, one additional lever of excess that's probably not needed in this system.
Yeah, I do fear, I'm sorry to say, the risks of a major downside move or major upside move, squeezing people the wrong way on those levered ETFs. It has disaster written all over it. Next question for you, though, on a technical basis. We have been bouncing all over the place, but have had a hard time staying above, we'll call it the 260 level on stocks above the 200-day moving average in the S&P 500. Right now, tonight, we closed at 247. It seems like, as you said, it's starting to peter out with a distribution. Should that fall back below the 200 level, do you feel a major corrective event could be in the offing? Now, by major, I'm talking 3 to 7%, nothing insane, but something that would be normal within a prolonged move like we've had.
Yeah, no, I mean, I think that's definitely overdue at this point. And really, from the lows, we have not seen any kind of meaningful supply trapped off sides. And now that we've sort of gotten to the point where we've gotten it all in, on the long side, you may still find some charts that's showing participants are under positioned. I don't really see that. I think it's a little bit extended. So I think something like 3 to 7 is completely reasonable at this point, particularly given, some of the breadth that we're seeing, and the way that, the Qs are acting in particular, in ES. So I just don't see a whole lot of a reason for additional upside here, given some of the exits we're taking. And that could be wrong. I mean, maybe we just chop around for a couple more weeks and we find some, rotations, and then rip to new highs. But I mean, again, like, this isn't a spot that I'm messing around trying to initiate a whole lot in the way of new longs here. I definitely am going to require, and like, again, you can always play rotations. That's fine, but I would rather play rotations when, some of the longs have been a little bit washed out first, right? So even if there's not something that's, even 7%, even if it's 2, or even if it's 3, then that's at least a meaningful pullback to loosen things up just a little bit. And maybe some fresh money can step in at that point. But usually they're too busy puking their longs to buy the dip too quickly and meaningful size. And I do feel like we're probably extended just enough up here, where, a downside move, we're gonna need to get, I don't know, probably down through. We closed today, on SPY, I guess 594.27, yes, around 60.25. We're probably gonna need 591 or lower, to see a little bit of puke, if you're looking at SPY. So basically, today's low minus, a $1.80 or so, I guess it is, on SPY, and 18 handles on ES. Something like traction below there should loosen things up, get a little bit of puke, and then it's probably going to be a few days, and then that dip gets bought. And the question there is, then does it, form out a larger distributive balance that could break either way, or is it something more like a 5%, 7%? But we haven't had much in the way of pullbacks off that low. So I mean, if you're crying about a 5% pullback, then I mean, come on.
There'll be some cherries to pick for sure once you get a 5% pullback. I'm not going to argue that point because I think the instability inherent with this year is going to continue through the end of this year. And I also believe that we're not going to see any kind of stabilization until December, especially depending on what is said at Jackson Hole. That's the macro in me, folks. Sorry. One other subject that I love to talk about, McClellan oscillator. We're heading and trending lower in a very continuous stair-step fashion. Are you concerned to see the breadth, everything starting to deteriorate, like you said, with the distribution? Do you feel that that is a reliable indicator as a predictive short-term indicator for the corrections we were just discussing?
I mean, I think it is. I usually will just glance at it and look at it and see, is it getting a little bit hot or is it getting a little bit oversold? And I don't usually monitor because I can usually just see it in the tape, right? The distributive process. I can generally just see that in the action on the index. But it's definitely a nice supporting indicator for me to see, maybe there's a divergence in the oscillator or, a grind, let's say a grind lower in breadth as the index is making like nominal higher highs, right? That continue to get sold into. Then that's something that I may use as like supporting evidence that things might just be a little bit stretched. And I feel like that's where we're at now. So,
Farm, I appreciate you coming on with us tonight, but I got to ask you one more question before we close this out because we're going to bring our other guests on to talk about real estate. But you have provided some interesting perspective from a technical point of view. Is there opportunities in the IWM? For some reason, I can't. There are opportunities in the Qs as far as I can see, especially individual equities, but I don't feel like the small caps have provided a whole lot of consistency as far as breaking out of their declining range over the last 5 years. I'd like to hear your take on that.
Yeah, I mean, I'm going to accidentally flip into a little bit of macro here, but I mean, my take on the IWM is like it kind of needs Goldilocks to rally, right? I mean, like, if inflation is too high, rates are too high, it's hard for it to perform. And if growth is too low, it's hard for it to perform. So, I mean, the market's really got to be in the mood to bid a basket full of shit to bid the IWM. So I feel like it needs to be kind of perfect. And, I don't feel like we have that, right? We have the opposite. If anything, we've got, it looks stagflationary, at least to me. So, I can't get behind any kind of meaningful longs outside of, rotational trades in a lot of the IWM names. I think you have to be very, very selective. But again, not the index. To me, if you want to pick out, companies that have better balance sheets that are perhaps less impacted by, broad economic growth, then take your shots and maybe like pair those trades, right, against some of those companies that are more susceptible or even just the index itself as it chops, sell calls on the index.
It's a similar process in that, let's say I just got a call
Whoa.
from the government, my bank's failed, I'm on the list of customers.
Hold on a minute here. What the heck? I think we have a problem here. Don, are you there? Farm, apologize for that. I think he hit his microphone on by mistake. We're good? Awesome. Welcome to live radio, boys and girls. Sir, one more time, promote yourself on X/Twitter and anywhere else that you can be found. I really appreciate your time tonight, and we would like to have this discussion again because I know a lot of people, their eyes bleed when you start talking technical analysis. However, it is a foundational part of having a broader view of your portfolio and its performance. The people who just say, well, I saw Tom Lee on TV. Hell yeah, I'm going to pick on that son of a bitch every chance I get. You need to really go more in depth than, well, the TV said, as a basis for pouring your good hard-earned money into things. Sir, please promote yourself.
Yeah, so I mean, you definitely follow me on X. If you can tolerate a little bit of shit posting, I think it's a decent follow. I do have, a Substack at sort of a lower price point where you can just kind of get, my weekly plans, and then one where you can get the weekly and the daily plans. And then I do have the Discord as well. If you've got the bandwidth for, more of the intraday and live discussion and commentary and learning things of that sort. Again, I like to teach what I see. and explain what I'm seeing, as opposed to, hey, you just kind of read a plan and here's the pivot for the day, long above it and short below it, and then you just get chopped to hell all day. And so, we do some day trading of the index, and then we also do swing some commons occasionally, or swing the index. We were there at the top. The thing about my service is that I get a lot of bad rap about being a perma bear, but I kind of own that. I do enjoy trading the short side, but I'll tell you, there's two types of people that have stayed the longest in the service. There's recovering perma bears that have just gotten completely rinsed over time and lost a lot of money shorting when they shouldn't be, and they stay because they know that if I'm not short, and they're going to get wrecked. And then the other side is the bulls that like to be long, right? And I'm there to let them know when, hey, it's probably not time to be long, right? And then on the flip side of that, they know that when I stop shorting it, it's just time to just get tits long, just get it all in. And so, we've got a mixture of people in there, but I like to think that the value is derived from, the explanation, and some of the education. And sure, we have some alerts. That's great too. But I'm more interested in teaching people, how to trade, how things work, and explaining what I see, as opposed to holding hands. So it's not for everybody, for sure.
Farm, thank you so much. And if we don't shit post, we'll all lose our mind. Thank you for joining us on MacroEdge Radio tonight. And folks, make sure you follow him on X. It is an interesting read. And if you're an intraday trader, a short-term trader, or a long-term trader, you can get an education. Folks, real quick reminder before we jump into the real estate fray, because that's ugly right now, and it's about to get uglier. Don't forget to go to macroedge.net/ozone, macroedge.net/ozone. Get your 2-week free subscription. You got to take advantage of it. Some of the commentary we write about is a little bit sharper, a little bit more tart than what you might read online. And we're pretty doggone snarky when it gets to some things. We're going to sit there and try to keep presenting options to you, not to accept just the mainstream. The mainstream financial media is dead. Their job is to promote buying crap, period. Our job is to prevent alternate opinions so you don't lose your ass in the markets, in your home purchases, in your commercial real estate investments, and on and on and on. We just provide data, push it, and let you form your own opinions. Without further ado, two of our favorite real estate guests are coming on with us today. Lance Lambert from Resi and Ulysses Awsumb. Gentlemen, welcome to MacroEdge Radio again.
Thank you for having me.
Well,
Always
I'm going
to be here.
Ulysses, good to hear you. Lance, good to hear your voice. Lance, what is your latest take on what we're seeing? We'll start with residential first. And there's a lot of disturbing trends appearing. What I'm seeing in Florida is one thing. Of course, I have a small myopic view because I see Lakewood Ranch, which is right down the street from me. I see Palmer Ranch. I see Venice. I see Northport. And we're heading on the same parallel, especially Cape Coral, as 2007, 2008 from our view down here. What are you seeing on a national scale that's caught your attention lately since our last time?
Well, give me a second to zoom out and then I'll go to the present. And I think it's always good to kind of take a step back and go all the way back to March 2020 and into 2020. There was so much demand that got created very early on during the pandemic, from the ultra low rates, making so many properties cash flow, and all of the quantitative easing that the Fed's doing. That's just pushing liquidity into the economy, all the stimulus, and then the increase in housing demand from work from home arbitrage, where you could take your higher salaries in New York, San Francisco, Seattle, and buy them in more affordable markets, right? So there was that net domestic migration wave, right? And then also even the places who stayed, even a lot of the people who stayed in those markets that lost people during COVID, those people, many of them wanted more space, or they were working from home and used to seeing their roommate 2 hours a day, and then we're seeing them 16 hours a day, hated their guts, and wanted something else. So much housing demand poured in to housing at one time. And with housing demand, both up and down is much more elastic than supply. And so the housing market could not absorb all of that demand, and it overheated prices. And the Federal Reserve estimates that housing starts would have needed to increase 300% to absorb that full burst of housing demand during the pandemic. That's not possible, right? You can't increase housing starts like that. That's just not how housing has ever worked. And so we saw this boom with national home prices going up 40, 45%, and in some of these markets going up 60, 70%. And so what that did is the intrinsic value of a home was not worth as much as they were transacting for, right? So that's, I view a lot of the housing market, especially in 2022, is overvalued. And then some of these places got kind of significantly overvalued. Think like the Austins of the world. And into 2022, as mortgage rates shoot up from 3% to 4% to 5% to 6% to 7%, the market has this huge affordability shock that pulls a lot of demand out of the housing market. Now, after that initial shock was kind of absorbed in 2022, and a good number of the markets, especially in the West, and then some of these boom towns like the Austins, Phoenixes, Boise's of the world were in correction. At the end of 2022, going into the spring of 2023, the market started to stabilize a bit. And the reason being is that despite that very strained affordability that we had gotten to, the market, the technicals of the market, the active listings were still fairly tight. But what it's done for the housing market is that it's not necessarily been as stable and steady as some of the numbers have appeared, because this market still has this very strained affordability, right? And many markets still overvalued. And so over time, as these active listings have risen from the strained affordability, and we've gotten more slack in the market, and we've gotten more spec inventory that's completed and not being sold, what it's done is that supply demand equilibrium in more places is moving into a direction that is favoring buyers more and more. And so we're seeing more of these markets slip into correction mode. And I know it won't work forever, but if you take a market and look at where it was for active inventory in 2019, and then you look at where it is now, the markets that have gotten back to 2019 levels or shot above it have been the ones where the supply-demand equilibrium has really shifted into a place that has favored buyers and more likely to push that market into an outright correction. And so where are those places? Many of them are the exact places that got the most overvalued during the pandemic housing boom: Austin's, Tampa's, Jacksonville's, Orlando's of the world. And then and then a lot of these other places are places that have had a lot of the multifamily supply, single family supply that's come into the market. And so as that supply has come into the market and builders have needed to do bigger and bigger affordability adjustments to move that product, what it's done, it's pulled some of the buyers who would have otherwise went to the existing market, and it's pulled them into new construction. And so as that occurs, it puts additional upward pressure on resale inventory as some of their buyers obviously going to the new construction side. And so that's kind of like the big picture. And then going into this year, what we saw is the softening kind of picked up steam. And it picked up steam because that supply-demand equilibrium, which had been slowly working up the whole time, in a favor of buyers, it kind of got really close to those thresholds that where you really start to see greater weakening, and it starts to cause greater weakening into the numbers. And so as that's kind of occurred, what it's done for these builders and many of the markets is that they are seeing some of their buyers go to the maybe looking at some of the existing inventory that started to build up. And so they've had to go out and do greater affordability adjustments this spring. And they did it in Q4 heading into this year as well. And that's what you see when you look at like Lennar's earnings report, where Lennar, back in 2022, 21, had the highest ever margins. And then they've slowly worked down. And then now Q1 2025 was their lowest in over a decade. And then Q2 2025 was essentially the lowest in a decade. And the only reason it wasn't is because in like 2016, they had an acquisition that caused a 1 quarter bigger slump in their earnings. And Lennar, this past quarter, they had a 13.3% incentive rate as a share of home sales. And so what that means on a $450,000 house, Lennar is typically spending around $60,000 on sales and incentives. And normally for Lennar, they're spending 5%, 6% sales incentives. 13% is very high. It's the highest since 2009 for them. And at the height of the pandemic.
Whoa. Did you say 2009?
Yeah, late 2009 for Lennar.
Holy crap.
And now, if you go back during the height of the pandemic housing boom for Lennar, they were offering 1.5% sales incentive. And normal is around 5 to 6%. And then right now they're at 13%. Now, I should put a little bit of an asterisk there, which is of all the major home builders in the country, Lennar has been the most aggressive, pushing sales pace and maintaining sales pace over margin. And how Lennar executives view it, and they're telling the market, is they're telling investors, hey, we see this market is still undersupplied. We think there's this big supply shortage. And I'm not speaking my opinion here, I'm giving Lennar's. They think the market has a supply shortage and that we are going through a weakening that's going to be temporary. And they are going to cut their margin and try to take market share. So that's the view of Lennar. Now, I don't know how many people here were following home building 2 decades ago, but Lennar actually did the exact opposite 2 decades ago. They were one of the builders who was like, you know what, we're going to be a little more conservative here, and we are going to try to keep some of our maintain or protect margin. And they cut back more on sales space. And DR was kind of a little bit of the opposite. Now, this time around, if you look at the numbers that DR put out, their margin has not come down as much. They are seeing margin compression, don't get me wrong, but they're not seeing the margin compression that Lennar is. But on the other side, Lennar's sales are pretty much flat. DRs are down double digits and down double digits across almost all the country. And so you're starting to see some of these builders who've compressed their margins and compressed it near pre-pandemic levels are now starting to get more conservative and are starting to cut back on starts. You've seen some in these boom towns where unsold spec inventory has shot up. You've seen some of these builders offload some land. So that's with some of the big builders at the moment. And then in terms of geographical dispersion across the U.S. housing market, I would still classify this as very bifurcated housing market, but not bifurcated in the sense of 2024. In 2024 spring, you had bifurcation at a similar percentage point distance, but overall, you've seen the market soften across the board. So of the 50 largest markets right now, 49 have a lower rate of year-over-year appreciation compared to a year ago. And the only exception is New Orleans. And instead of being down year-over-year 8%, they're down year-over-year like 3 or 4%. So really, it's essentially the whole country is softened in that sense. Now, you do still have, let's say, 55, 60, 70% of markets up year-over-year in like the Zillow Home Value Index, but that share is shrinking and it's getting closer and closer to having national appreciation on an aggregated basis for condo and single family to be negative. And right now, the Zillow Home Value Index is up 0.4%. And it looks like sometime in the next 2 months, that'll go negative year over year. And then
Well,
FHF.
but real quick, and I'm going to bring Ulysses into this too, sir. Is not the Zillow index based on actual? Is it based on actual selling price, or is it based on asking price?
Yeah.
Because a lot of the asking prices, especially in my market, which is the king and queen of delusion when you take it from Tampa down to Naples, is actually gone off the charts stupid, and they still are refusing to acknowledge that we're oversupplied, yet our builders, including Lennar and DR Horton and all the other big boys, are still rushing completions. And that is the scary part. They're trying to build everything up and squeezing builders or subcontractor margins versus their own. Ulysses, do you want to hop in there?
Yeah,
I guess he can't hear me.
Do you want
Yeah,
me to
please
tell you
do.
how the Zillow Home Value Index is
Oh
calculated?
yeah, go ahead, please, and then let Ulysses get in there about the margins.
Yeah, so the Zillow Home Value Index is the middle of the market. It's the 35th percentile to the 65th percentile, the one that I cite. They also have a top one, they have a bottom one. You can cut it by condo, you can cut it by single family. And it's their valuation of housing. And there's a lot of different metrics that go into it, but they're not exactly forthright with what their methodology is. So like Case Shiller, you can go download the 40-page paper, read all their analysis for the repeat sales. Zillow Home Value Index, you can't necessarily do that. Now, you're probably asking, why would I even use the Zillow Home Value Index? And the reason is that despite them not showing their methodology, the entire time that I've been doing housing data, about 8 years, the Zillow Home Value Index leads the repeat sales indices, and not just on a national level, but even the local markets. It's been ahead of them for years. And the repeat sales, well, you're probably asking, well, why do I like repeat sales? I do follow median list price as well. I follow median sales price as well. But I like the repeat sales indices for trying to attempt to account for mix shift, because I do have these times, and this predates the pandemic housing boom, where when I was working at realtor.com and I would use their data for median list price or price per square foot, and I would see markets that, maybe saw a swing 15% up or, this drop, right? And then I would call around and start talking to people and trying to look at like homes for sale right now versus, a couple years prior to try to get a glimpse of what was going on in the market. And what I would see is the market was just very different from the data. And a lot of times those ones that pop up really high, sometimes for median lists or average list or median sales price, there's some noise there. And I think some of that noise is probably the mix shift. And then some of the noise is just because they throw everything in and take the average or the median. Now, these repeat sales indices over time, what I have found is that yeah, maybe they might not be perfect. Like maybe there's a weakening in a market and maybe they're not showing all of it. Because at the end of the day, in housing, home prices can fall and go up in ways that don't necessarily feed into the numbers. And what I mean by that is if I wanted to sell a property today and I needed to spend 15,000 more on renovations for the home to get a price that's maybe still 5% or 3% below 2022, and I do that, was that home value only down 2-3% like the comps would show, or was it much more because I had to spend that 15,000 or 20,000 on renovations just to get kind of close to that number? So there is always going to be this weakening that might not get caught in the data when you have a down period. And it can also work the other way, where like during the pandemic housing boom, when home prices are ripping and some people are selling homes contingent with the buyer, allowing them to stay in the home rent free for 6-7 months. That's not in the home price, but that's an additional swing up on home values that doesn't get registered.
Ulysses, is my
Yeah.
perspective incorrect? Are the builders squeezing their contractors to keep their margins healthy? Because you're in that mix on a daily basis. You're seeing what's going on. And we're also seeing a lot of spec building that's unnecessary. I'm seeing a lot of the local builders, custom builders, what they used to be called. Now they're local spec builders, building homes on a for sale or rent or lease basis. What are you seeing, though, as far as margin compression on the building side of this? Because everyone says, well, Lennar is a home builder. They don't own their own construction crews, folks. They hire contractors. Fill us in, sir.
Yeah, well, why don't I touch base on that just for everybody listening? Lennar, as you said, they do not have their own crews that are building homes. They employ construction management teams, and that usually consists of like a project superintendent and an assistant superintendent, and area managers. And so they have subcontractors that build for them across the country. And they're absolutely passing some of those cost savings down to subcontractors. And that's part of the business. I've seen the requests several times from Lennar themselves this year, as well as some other builders, to have some of the subcontractors share in some of that margin compression. And it's been going on 2 years. One of the things that Lennar that we've seen this last quarter, their net income was cut in half, literally 50% from 2024, and their stock price has now been cut by 46% as of end of close today. One of the things that Lennar has been doing better at, however, than a lot of other builders is they're actually increasing their sales numbers from last year. And this is part of their business plan. So they have more active communities than they did last year. They have more active communities than they had the year before. So the name of their business is to continue to grow, and they do want to take market share. And one of the ways that they're doing that is they're reducing prices, not just adding incentives into the picture. Now, how that affects smaller contractors, as long as they have enough work that's going to be able to keep them going, and with our building at the pace that they are, they've got a good runway there. The issue arises, if mortgage rates continue to be elevated, if sales in the third quarter and the fourth quarter trend downward as they do historically in the second half of the year, what's that going to have on an impact on Lennar's third quarter, fourth quarter net income, and what result is that going to have on their outlook of attempting to increase sales over the prior year? A lot of the smaller builders, even the 10th through 20th largest publicly traded builders, they don't have the footprint or the income that Lennar does to be able to take these types of hits where they can say, yeah, no problem, we'll cut our margin in half, but we're going to sell more product. A lot of them, if they do that, you're going to hear about filing bankruptcy.
So let's proceed on. Lance, I've got a question from GBR, one of our team members and listeners. Starts for home builders are down, but the pace of the decrease is not as steep as some of us expected. What do you think of this?
Well, I think some of it is, what Mr. Awesumb just said, which is the margin compression, right? Where they're still kind of playing with the margin that is not necessarily, it worked, they came into this down period, this part of the down cycle, the downturn for housing, whatever you want to call this, in 2022 with record margins. And they've since been working down on them. Entering into 2024, of the 10 that I track that are the biggest, 9 still had margins above pre-pandemic levels. And then you go through the past 15, 16 months, you've worked it down more, and this margin compression that we've seen, they're using it for incentives. Some of them are using it for some outright price cuts, and that's helped them to continue, to keep up some of the pace. And so some of the decrease that would have otherwise happened for starts has fallen onto the margin. But I do think you're getting to this point where more of the builders are starting to focus on protecting margins. And as you've kind of gotten closer to that pre-pandemic level and slipped under it for more of these builders, I think you'll see some of the decrease in starts. And that's where you'll start to have more of an impact if this continues for construction employment. And I see Kenny here. Kenny has a great chart that he does for year-over-year change for residential construction. And while residential construction employment is at an all-time high, essentially at a cycle high, the rate of growth for it has completely decelerated to almost nothing. And then if you look at specialty contractors, that's actually started to contract a little bit. Now we're not seeing a huge contraction there, but if you zoom out and you take a total picture at the margins of builders, if you look at the affordability here, and if you look at just the slowing employment there, I think it's painting a picture for you to where if this weakening continues, you'll start to have a greater pullback in activity for residential construction, and then you would have a greater pullback for employment. And that's where you really start to get a greater impact for the overall economy. Because at this point, housing has taken off some growth. You look at residential construction GDP, it's down from its cycle highs 21, 22, and some of that is the parts of it that are related to like real estate commission, the overall transaction side. That is a little bit of it, but residential construction is really the driver of housing's contribution to the economy. And so if the weakening were to continue and we start to see a greater rollover, that's where you get a little bit more concerned on housing's contribution to the economy.
Ulysses, I'm going to throw back at
wanna,
you real. Oh, go ahead, Ulysses. Go ahead. I'm sorry.
Yeah, I just wanted to touch on that regarding the permits or units under construction, because we have seen contraction over the last 2 years as well in construction, residential space. The majority of that has been in the what we'll call not spec, but the custom built, by a home builder. Somebody contracts someone to build a home for them. Somebody builds their own home, and then of course apartment units have been falling. The number of units under construction over the last year and a half as well. So that's been where the leading contraction in residential construction has been so far.
Yeah, exactly what Mr. Awsumb said, which is multifamily. If you look at the numbers, multifamily completions have kind of been fairly resilient, but that's really just been that echo of the huge amount that were financed in 21, 22 when rates were so low, and as that came into the market, and 2024 was like the highest since like 1974 for multifamily completions. But if you look at the data that leads that, which is multifamily permits, multifamily starts, those have rolled way over from the highs of 21, 22. And so, as we really start to see now the deceleration of multifamily completions, that kind of goes back to the point earlier where you keep an eye on residential construction employment right now.
Ulysses, real quick. And I bring this up because this is pertinent to what you just brought up with Lance. The gross amount of total CRE debt hit 4.81 trillion this week. Now, I'm not so disturbed about the large number because a lot of that is refinancing and rollovers. However, you see new loan originations muted, of course, but commercial banks, which is my concern, and thrifts, which is a lot of the regional and community banks and credit unions, as I started the show off with tonight, hold a 38% market share at 1.8 trillion. Are we getting to that point where at some X date they have to start marking these properties to reality and foreclosing on them?
Well, we're getting close by some standards. The International Monetary Fund and CoStar both have their own commercial real estate property price indexes. We had never seen 5 consecutive quarters of price contraction without having whole mortgage assets impacted, meaning not just write downs on or losses for sellers on commercial real estate property, but that's actually impacting bondholders, the most secured, the lenders on those real estate assets. We're now past 5 quarters and we have not gone negative yet. We're also into the 6th consecutive quarter of contraction on the CoStar price index. And if you look at just the issuance and value of all mortgage asset transactions tied to commercial real estate for the United States, which is tracked through the Z1 financial accounts of the US through the Federal Reserve, we have seen the values come very close to outright being negative. And that's happened in the past. And what that means is that the overall value of those mortgages, so not just the losses for property owners, not just the losses for investors, but the lenders themselves begin to take losses at a greater share than prices, new mortgages that are being originated and replacing old debt or new acquisitions, but actual outright contraction in value of those loans, we're really close to that. And if things don't improve in the next quarter or two, we could see that go negative again. And of course, the last 3 times that happened in 2008, 2009, and 2010. That happened very briefly for a quarter in 2001. And then it happened in 1989, 1990. And of course, that was an even bigger time that happened, that we got the Resolution Trust Corporation. So if the macroeconomic situation doesn't improve soon, we might begin to see more of the commercial properties get marked down. There's still areas where, just like the residential market, those values are holding up and good properties are transacting, despite some of these properties that are selling at pennies on the dollar.
Well, Ulysses, you just brought me to my next question, because I'm seeing a large amount of multifamily down here sitting 30 to 50% unoccupied a year after it's been built. We're also starting to see some of the elderly people who have lived 30 years in their lifetime and never had a lot of hurricanes said, "The hell with this, I need to go to a nursing home up north," and selling at a loss before getting the assessments on some of their properties in the condominiums. Is that downward pressure, and I know it's not just Florida, it's Texas, it's Arizona, it's especially California, they're just not talking about it. Is that not going to put more pressure on the financing side for future development of multifamily at some point? Everyone's pointing to interest rates, including our president, who has no clue how this operates. But when you start looking at the bigger picture, if we stay in that 7% range for residential mortgages and 6 to 8% for commercial, eventually something's going to break, like you said. How close to that point are we where multifamily LLCs, et cetera, just say the hell with it, liquidate and start over?
Well, we've already seen a lot of, what you call jingle mail. People sending keys to properties back to the lenders and just saying, we're done. People that can do that, right? It's non-recourse debt in states that have that ability. There's been a lot of that. It hasn't yet been to the point where it's outpacing other types. It's certainly the developments going on, but all of that is negative pressure. And I guess the question that I would pose is, given that what we have, and we continue to hear from everybody, what I hear from business contacts, what I hear through everybody here on X, Twitter, what we hear in the news is uncertainty. When you have an extended period of uncertainty, generally speaking, when it becomes more certain, is that because the situation has materially improved, or because the situation has become painfully clear that it's not going to improve in the immediate term, despite having the ability to at a later date?
So in other words, we're screwed. Okay. Because right now I don't see anything to indicate that we're going to see stability in interest rates or financing from that perspective. And that means that we're going to see a gross amount of instability. Lance, I got to come back to you because we're going to wrap this up here in about 5 minutes. I apologize for not taking any messages or calls from anyone today. but we've got to wrap this up because our host has important matters to attend to. With what's happening in the residential market and incomes basically stagnating on an inflation-adjusted basis, despite all the Truth Social postings, where do you see this heading, since 60+% of people have fantastic mortgage rates, no reason to sell their affordable housing, and no desire to upgrade to higher priced housing at a higher interest rate?
Oh boy. So I think the thing I'm keeping an eye on here is continuing to watch active inventory, which we've been rising now for a while. And if you really just zoom out and you kind of ignore a bit of the tightening up that occurred in heading into 2023, inventory has pretty much been rising the whole time since the mortgage rate shock. If you kind of just kind of adjust for it jumping up a bit higher than it otherwise would have in 22, and then a bit of tightening. And if you zoom out, it's been rising pretty much the whole time. And so as we get closer on a national basis to 2019, where then does active inventory continue to head? Because if you run the numbers and sales don't start to increase, but we start to see a normalization also of new listings, and if we were to start to see a full normalization of days on the market before pending, if those two were to normalize and sales don't start to pick up, active inventory for sale would really start to move well above 2019 levels. And that's not with any foreclosures or anything like that. That's just days on market before pending normalizing and new listings normalizing, and active listings or for sale and months of supply would really shoot up if we don't also see sales move up. So that's really what I'm watching right now is months of supply, active inventory for sale, and seeing the other metrics starting to normalize a bit more, like new listings and like days on market before pending. And I'll put out some charts on the latter part because I don't talk about it as much, the days on market before pending. But I think that's a really important one, and kind of seeing how that's varied across the country. So that's really what I'm watching. And then, the number of newly completed homes for sale that are unsold, that's another very important measurement of slack for the housing market. So as we start to see more of these numbers getting closer to pre-pandemic levels, do we kind of start to get steady there, or do we really start to shoot up more? I think that's the big questions that I have for housing over the next 6 to 12 months. Now, one last point I want to make, which is the housing markets that have really completely decelerated and seen no appreciation this spring. Just to give everybody a heads up, those are going to be the markets that see the most price give up in the second half. Now, if you have the markets like a Tampa or some of these places in Florida that have already seen give up in the stronger spring season, they're really going to give up in the second half. Now, the markets that have kind of still saw a little bit of appreciation, maybe those would kind of be the flatter places for the year. But how you hold up in the spring, if you're closer to zero or you slightly tip under zero in the spring, then you really have give up in the second half.
Lance, real quick, promote your website, Resi Club, and let everybody know where they can find you on X.
Well, they can find me right here, News Lambert on X, and then I also have a site called ResiClubAnalytics.com.
Thank you so much for your insights tonight. I appreciate it. Ulysses, promote your Substack. Tell us where to find you, although you and I find each other all the time because we have long conversations. Let everybody know where they can find you on the internet and on X.
Yeah, thank you. Just for all the new listeners, my handle is Mr. Awesome at X, and that's because that actually is my name. That's not a joke. But you can also find me. I do a weekly column on markets and construction in particular at thememo.net. And then you can also find my writings in MacroEdge, of course.
Awesome. Mr. Awesome, seriously, that is fantastic. And by the way, he is a TV star. He has been on with Charles Payne. If you never saw that appearance, Go to YouTube and search for it. He did a fantastic job and made us all proud. Folks, we apologize for not being able to take any of our listeners' questions directly on air. MacroEdge.net/ozone, MacroEdge.net/ozone. Get a 2-week free trial. If any of you follow me at JohnGaltFLA.com or at MacroEdge, you know I am a freak when it comes to monitoring international situations, especially the Middle East, which is more of my forte. Just to give you a quick heads up, it looks like we've got about 48 hours before any kind of U.S. action happens based on the positions of where our stealth bombers are. They will not arrive in Diego Garcia until at least late Sunday night, early Monday morning at the very earliest. So it would appear that we've got some time for some quote unquote more negotiations. Watch the Sunday night futures, though. That will be your key as to where reality is happening. If you suddenly start seeing sharp spikes in gold, oil, etc., you'll know the game is on. For MacroEdge Radio, we'll see you next Friday night. I repeat, next Friday night, 8 p.m. Eastern, 5 p.m. Pacific for those of you in Rio Linda, California. Good night now.